Hello, my name's David Miller. I'm the manager of Nexus Global Solutions portfolio and the co-manager of Dynamic. I'm in London, it's early March, spring is in the air. So February was another good month for markets, continuing the recovery that kicked off just after Christmas. So we have Dynamic with its heavy equity weighting up about 5%, 5.5% in the month, bringing it to 8.5% for the year as a whole. Solutions with more diversification up 1%, 1.2% in the month and 4.5% for the year. So both portfolios are performing well. We were in the markets at the right time and we've captured the upside. So what's changed since I last reported to you? What's changed since the last part of last year when markets were going down? Well, of course, a lot. But what really matters to markets is the cost of money, and particularly the cost of US money. The Federal Reserve in the US is responsible for that. And since the end of last year, they've changed their mind. 180-degree change. Instead of increasing interest rates, it's quite possible that rates will either stay the same or even fall this year. Instead of reversing quantitative easing by withdrawing cash from the system, they've said they won't do that. This is a big change and markets have responded accordingly. It's quite clear that the US Federal Reserve and other central banks around the world, particularly the Chinese, don't want a recession. If they don't want a recession, we're in a position to invest in economic growth, and that's what we're doing, hence the returns we've seen. Now, that hasn't needed a big change of asset allocation. Dynamic is still 95% invested in equities, 5% in cash. Solutions is about 55% in equities, 30% in fixed interest and cash, and the balance of about 15% in alternatives. That hasn't changed much. Stock selection, yes, of course, changes. It's an exciting time to be investing in companies that are benefiting from all the changes we're seeing around us. And it's across the board. There are winners and there are losers. That's what active management is about, trying to find those winners. It doesn't mean we do nothing. So in US technology, where we've had good returns over the last few years, we're taking a little bit of risk off the table, taking profits in AMD and Electronic Arts, reinvesting in Texas Instruments and Cisco, which are more lowly rated. So making sensible decisions. Then in Europe, we have a whole range of companies, Schneider, Siemens, LVMH, all making good returns for investors. And part of the portfolio. In the UK, we'll come to Brexit in a moment, but the Brexit discount is quite clear in the ratings that we have to pay, or the prices we have to pay to invest in UK equities. And so just over the last few weeks, we started to increase exposure to companies in the UK that are more exposed to the UK domestic economy, the areas that seem most likely to be affected by a hard Brexit. So valuation drives what we do. If we can invest in Lloyds Bank or a house builder, we're going to do that at the right time in the market, and that's what we're trying to get right. So it's not just about equities. In solutions, we also have investments in fixed interest. The focus has been and remains on top quality corporate bonds and British government stocks. That paid off during the latter part of last year when equity markets were uncertain, and it's not doing us any harm so far this year. That's the emphasis in the portfolio. I want to be certain that we have quality and liquidity. And then in alternatives, the area that stood out last month as doing particularly well were the hedge funds. We have 4 or 5 funds in the portfolio. We try to pick those that are well managed, which give us diversification away from fixed interest and equities. And that, interestingly, has worked well despite the fact that it's been an up market for equities. So diversification pays off, not always every month, but on balance it's the right way to do it if you're looking to smooth both the upside and the downside. So that's where we are at the moment. The future. Well, the future, I think, is as ever misty, cloudy, hard to read, no more, no less today than it usually is. What's to come? Well, I think lots of numbers. If I say that we're data dependent, it means that We're going to look at the numbers as they come through, whether that's economic growth or company results, and make decisions. We can't always guess what those numbers are going to be in advance, but when they come out, they're going to tell us the future or give us a bit more information about the future. So that's important. The big things that we don't know, as I speak to you today, are the US-China trade discussions, which look as if they're coming towards some sort of slightly more positive conclusion. I think President Trump needs a deal after some recent failures, and the cynic says that's probably where we're going to see that. And that will be good for market sentiment if we get the deal done and the tariffs that were threatened go away. Then we have Brexit in the UK, and probably with a knock-on effect into Europe. Again, we're coming towards the end of the period when the exit should happen, 29th of March, but as ever, and as we've come to understand over the last 2 years, there isn't any great certainty. And as I said, the only thing we have been doing is looking for cheap stocks for value in a difficult time. But also, more generally, it's clear that the decisions to invest in the UK from outside have been delayed, and therefore there should be some sort of catch-up in due course, and we want to be in a position to benefit from that. Exciting times. Uncertainty reigns, of course, but there are opportunities, and we're investing both the portfolios, Dynamic and Solutions, in order to be in good position to take advantage of these events as they unfold. Thank you.